Robert is 63. He retired last spring after 39 years working as a regional operations manager for a logistics company. His mortgage is fully paid off. His children are financially independent. And after decades of saving through a 401k and IRA contributions, his retirement portfolio sits at $750,000. Robert's plan looks simple. Withdraw 4% per year. That equals $30,000 annually from his portfolio. Add Social Security. He began benefits at 63. About $2,100 per month, or roughly $25,000 per year. Combined income, just over $55,000 annually. For Robert, the math seemed reasonable. The house was paid for. His living expenses average around $50,000 a year. There was some margin, some flexibility, nothing extravagant, but stable. And the 4% rule is widely discussed in retirement planning. Withdraw about 4% annually, and historically, many portfolios have survived 30 years. So when Robert looked at his numbers, he believed something very simple. $750,000 should be enough. But there was one assumption hidden inside his plan, one variable that almost never shows up in the initial calculations. It wasn't spending, it wasn't taxes, and it wasn't even inflation. The real vulnerability was timing, specifically the timing of market returns during the first few years of retirement. Because two retirees can start with the exact same portfolio, withdraw the exact same amount, experience the exact same average market return over 20 years, and still end up with completely different outcomes. One portfolio survives comfortably, the other runs out of money before age 85. The difference often comes down to something surprisingly simple, not how much the market returns, but when those returns occur. So the real question isn't simply whether $750,000 is enough. The real question is this: what happens to a retirement portfolio when the market declines early while withdrawals are already underway? And over the next 20 years, what does that timing change? To understand Robert's retirement plan, we need to start with the basic structure of the numbers. His portfolio begins at $750,000. The strategy he follows is simple and widely referenced in retirement planning. Withdraw roughly 4% per year. 4% of $750,000 equals $30,000 annually. That withdrawal is designed to supplement Social Security and provide additional income during retirement. Robert's Social Security benefit at 63 is about $2,100 per month. That equals roughly $25,200 per year. So the full income structure looks like this. Portfolio withdrawals, $30,000. Social Security income, $25,200. Total annual income, approximately $55,200. For many retirees, that level of income is manageable. Housing costs are often lower once mortgages are paid off. Daily spending tends to stabilize, and travel or discretionary expenses can be adjusted if needed. But retirement math does not stop at income. The other half of the equation is portfolio growth. Most retirement models assume an average market return, often somewhere between 5 and 7% annually. Let's use a 6% average return assumption for Robert's portfolio. However, we also need to account for inflation. Historically, long-term inflation has averaged roughly 3% per year. So if the portfolio grows at 6% and inflation runs at 3%, the real growth rate of the portfolio is approximately 3% annually. Now here is how Robert expects the first year of retirement to look. His portfolio begins the year at $750,000. If the market returns 6%, the portfolio gains roughly $45,000. That would increase the portfolio to approximately $795,000. Then Robert withdraws his planned $30,000 for living expenses. Ending portfolio balance, roughly $765,000. From Robert's perspective, the system appears stable, the portfolio grows, withdrawals are manageable, and the remaining balance continues compounding. But this entire projection quietly assumes something important. It assumes that the average return appears smoothly over time. In reality, markets do not behave that way. Returns rarely arrive in neat, predictable sequences. Instead, they tend to cluster. Strong years often follow strong years, and difficult markets often arrive in groups. This creates one of the most important forces in retirement planning, a force known as sequence of returns risk. Sequence risk means that the order of market returns matters when withdrawals are being taken. If positive returns arrive early in retirement, the portfolio has time to grow before withdrawals begin reducing the balance. But if negative returns appear during the first few years, the situation changes dramatically, because withdrawals continue regardless of market conditions. When losses occur early, the portfolio shrinks faster, and once money leaves the portfolio, it can no longer participate in future recoveries. Over time, that creates a compounding effect, one that can quietly reshape the entire retirement outcome. To see how powerful this effect can become, we need to compare two different market environments. Both will average the same long-term return. Both will begin with the same $750,000 portfolio, and both will follow the same 4% withdrawal strategy. But the order of those returns will be different. And over the next 10 years, that difference alone will begin to reshape the entire retirement picture. Let's now examine two possible retirement environments for Robert. Both scenarios begin with the same starting point, a portfolio of $750,000. Both follow the same withdrawal strategy, approximately $30,000 per year, adjusted slightly for inflation over time. And both portfolios will ultimately experience a long-term average return of 6% annually. But the sequence of those returns will be different. In the first scenario, the market behaves relatively well during the early years of retirement. In the second scenario, the market experiences a difficult period during the first few years. Let's begin with the stable environment. In scenario 1, the early years of retirement are calm. The market produces returns close to its long-term average, around 6% annually for the first 5 years. Robert continues withdrawing about $30,000 per year to supplement his Social Security income. The portfolio grows modestly during this time. Withdrawals occur, but the investment gains partially offset them. After 10 years of retirement, Robert is now 73 years old, and his portfolio still sits somewhere in a range of roughly $720,000. In other words, after a decade of retirement withdrawals, the portfolio has declined only slightly from its starting value. From a planning perspective, this scenario feels reassuring. Robert continues receiving Social Security. His investment portfolio remains substantial, and the retirement plan appears sustainable. Now, let's look at a different environment. In scenario 2, the first few years of retirement arrive during a weaker market cycle. The long-term average return will still reach 6% eventually, but the early years are more volatile. Imagine the following sequence. Year 1, negative 12%. Year 2, negative 8%. Year 3, positive 4%. These types of short market cycles are not unusual. They have appeared multiple times throughout market history. But remember something important. Robert's withdrawals continue regardless of market performance. Even when the market declines, he still withdraws roughly $30,000 annually. During declining markets, that withdrawal accelerates the damage because the portfolio is shrinking from both sides, investment losses and cash withdrawals. After those early declines, the portfolio has less capital remaining to benefit from future recoveries. By the time the market stabilizes again, the portfolio base is smaller, which means future percentage gains produce smaller dollar increases. Now, let's look 10 years into retirement under the second scenario. Robert is still 73 years old. His spending habits haven't changed. His Social Security income remains the same. But the portfolio value is now dramatically different. Instead of sitting near $720,000, the portfolio may have declined to roughly $450,000. That is a difference of nearly $270,000. Both scenarios began with the same retirement savings. Both followed the same withdrawal strategy. Both ultimately experienced the same long-term market average. But by year 10, the portfolios are separated by more than $250,000. And this is where the retirement trajectory begins to change. Because a portfolio near $700,000 behaves very differently from a portfolio near $450,000. The next 5 years will begin to reveal just how large that difference can become. Let's now examine two possible retirement environments for Robert. Both scenarios begin with the same starting point, a portfolio of $750,000. Both follow the same withdrawal strategy, approximately $30,000 per year, adjusted slightly for inflation over time. And both portfolios will ultimately experience a long-term average return of 6% annually. But the sequence of those returns will be different. In the first scenario, the market behaves relatively well during the early years of retirement. In the second scenario, the market experiences a difficult period during the first few years. Let's begin with the stable environment. In scenario 1, the early years of retirement are calm. The market produces returns close to its long-term average, around 6% annually for the first 5 years. Robert continues withdrawing about $30,000 per year to supplement his Social Security income. The portfolio grows modestly during this time. Withdrawals occur, but the investment gains partially offset them. After 10 years of retirement, Robert is now 73 years old, and his portfolio still sits somewhere in a range of roughly $720,000. In other words, after a decade of retirement withdrawals, the portfolio has declined only slightly from its starting value. From a planning perspective, this scenario feels reassuring. Robert continues receiving Social Security. His investment portfolio remains substantial, and the retirement plan appears sustainable. Now, let's look at a different environment. In scenario 2, the first few years of retirement arrive during a weaker market cycle. The long-term average return will still reach 6% eventually, but the early years are more volatile. Imagine the following sequence. Year 1, negative 12%. Year 2, negative 8%. Year 3, positive 4%. These types of short market cycles are not unusual. They have appeared multiple times throughout market history. But remember something important. Robert's withdrawals continue regardless of market performance. Even when the market declines, he still withdraws roughly $30,000 annually. During declining markets, that withdrawal accelerates the damage because the portfolio is shrinking from both sides, investment losses and cash withdrawals. After those early declines, the portfolio has less capital remaining to benefit from future recoveries. By the time the market stabilizes again, the portfolio base is smaller, which means future percentage gains produce smaller dollar increases. Now, let's look 10 years into retirement under the second scenario. Robert is still 73 years old. His spending habits haven't changed. His Social Security income remains the same. But the portfolio value is now dramatically different. Instead of sitting near $720,000, the portfolio may have declined to roughly $450,000. That is a difference of nearly $270,000. Both scenarios began with the same retirement savings. Both followed the same withdrawal strategy. Both ultimately experienced the same long-term market average. But by year 10, the portfolios are separated by more than $250,000. And this is where the retirement trajectory begins to change. Because a portfolio near $700,000 behaves very differently from a portfolio near $450,000. The next 5 years will begin to reveal just how large that difference can become. In scenario 2, the early market losses have already reduced the portfolio to around $450,000 by year 10. Withdrawals have not stopped. Robert still relies on that income each year, and inflation continues to push spending slightly higher. By year 15 of retirement, annual withdrawals may also reach roughly $34,000 to $35,000. But the remaining portfolio balance is now much smaller. Instead of withdrawing 4% of the portfolio, Robert may now be withdrawing 8 to 10% of the remaining assets each year. And this is where the math begins to change. Because once withdrawals exceed sustainable levels, portfolio recovery becomes extremely difficult. Even if markets perform reasonably well in the future, a large percentage of gains must first replace the capital already withdrawn. By year 15, the second portfolio may have declined to roughly $280,000. Now compare the two outcomes again. In scenario 1, the portfolio still holds around $650,000. In scenario 2, the portfolio may hold closer to $280,000. That is a difference approaching $370,000. Yet the two retirements still look almost identical from the outside. Robert still lives in the same home. He still receives Social Security. His spending patterns have not dramatically changed. But underneath the surface, the financial structure is beginning to shift. Because once a portfolio drops below a certain threshold, every future year becomes more fragile. And the final phase of retirement will depend heavily on what remains. Which brings us to the most important question. What happens 20 to 25 years into retirement, when those two portfolios continue compounding in completely different directions? By year 15, the two retirement paths already look very different. In the stable market scenario, Robert's portfolio still holds roughly $650,000. In the difficult early market scenario, the portfolio has fallen closer to $280,000. From this point forward, the difference begins to compound more rapidly. Because investment growth depends on the size of the remaining portfolio. Larger portfolios generate larger dollar gains. Smaller portfolios generate smaller gains. And when withdrawals continue at the same time, that gap widens even further. Let's begin again with the stronger scenario. In scenario 1, Robert reaches 20 years of retirement. He is now 83 years old. Despite 2 decades of withdrawals, the portfolio has remained relatively resilient. Annual withdrawals may now approach roughly $38,000, adjusted gradually for inflation. But because the portfolio began retirement with favorable early returns, the balance has had time to compound. Around the 20-year mark, the portfolio may still hold approximately $500,000. At this stage, the retirement structure remains intact. Social Security income continues. The investment portfolio still provides flexibility, and the probability of running out of money remains relatively low. Now let's examine the second scenario again. In scenario 2, the early market declines permanently reduce the portfolio base. By year 15, the portfolio had already fallen to roughly $280,000. Withdrawals continued each year, and although markets eventually recovered and delivered average long-term returns, those gains were applied to a much smaller portfolio, which means the recovery was slower, and the withdrawals continued eroding the balance. By year 20 retirement, the portfolio may have declined to roughly $100,000. At this point, the remaining assets are extremely fragile. Even moderate withdrawals represent a very large percentage of the portfolio. And sometime between year 21 and year 23, the portfolio may become fully depleted. Now, compare the two retirements side by side. In the stable market sequence, Robert still holds roughly $500,000 in investment assets. In the difficult early sequence, the portfolio has already been exhausted. The two scenarios began with identical retirement savings, identical withdrawal plans, identical average market returns over the long term. But the order of those returns produced a completely different outcome. One retirement remained stable for more than 2 decades. The other struggled to survive past year 20. This is why retirement planning cannot rely solely on average return assumptions, because average returns hide one of the most important forces in retirement finance: the order in which those returns occur. And once that order begins working against a retiree, the consequences can compound quietly for years. So far, we have looked at Robert's retirement plan through one primary lens: portfolio withdrawals. But in real retirement planning, portfolios rarely operate in isolation. Several other variables interact with the withdrawal strategy. And in many cases, those variables can either stabilize a retirement plan or increase its fragility. Let's begin with the first one: Social Security timing. Robert began his Social Security benefits at age 63. That decision provided immediate income, about $2,100 per month. But Social Security benefits increase when retirees delay claiming. If Robert had waited until age 67, his full retirement age, his monthly benefit might have risen to approximately $3,000 per month. That is roughly $36,000 per year. Compare with the $25,000 annually he receives today. The difference is roughly $10,800 per year. Over 20 years of retirement, that additional income could total more than $200,000. More importantly, higher guaranteed income reduces the amount that must be withdrawn from the investment portfolio. And reducing withdrawals can significantly extend the life of retirement savings. Now, let's introduce another variable: healthcare inflation. Healthcare costs behave differently from most other living expenses. General inflation in the United States has historically averaged around 3% annually, but healthcare inflation often runs closer to 5 or 6% per year. Before Medicare eligibility at age 65, many retirees face particularly high insurance premiums, in some cases exceeding $10,000 to $15,000 per year. Even after Medicare begins, healthcare expenses continue rising over time. Across a 20-year retirement horizon, it is not uncommon for total healthcare costs to exceed $300,000. That cost must ultimately come from somewhere, either guaranteed income or investment withdrawals. And if those withdrawals occur during unfavorable market periods, the compounding impact becomes even stronger. Now, let's look at a third variable: withdrawal flexibility. Many retirement plans assume withdrawals remain constant each year. But in practice, some retirees adjust spending during difficult market periods. For example, reducing discretionary spending temporarily, delaying major purchases, or postponing travel during market downturns. Even a modest adjustment can significantly improve long-term portfolio survival. Imagine reducing withdrawals by 10% during major market declines. That single adjustment can slow portfolio erosion and allow the remaining assets more time to recover. Over 20 years, this type of flexibility can extend the life of a portfolio by several additional years. And when combined with stronger guaranteed income, the difference becomes even more powerful. But this raises an important modeling question. If a retirement plan only works when markets cooperate, is the plan truly stable? Or is it quietly dependent on a sequence of returns that no retiree can control? By this point, Robert's retirement plan looks very different depending on which market sequence occurred early. In one scenario, the portfolio remains near $500,000 after 2 decades. In another scenario, the portfolio has already been exhausted. Yet the starting conditions were identical. Same savings, same withdrawal strategy, same long-term market average. The only difference was when those returns occurred. This leads to an important question for anyone evaluating a retirement plan. If a portfolio depends on an average return assumption, but markets rarely deliver returns in a predictable sequence, how resilient is the plan if those returns arrive in the wrong order? Because retirement is not only a mathematical exercise, it is also a psychological one. When markets perform well during the early years of retirement, confidence tends to grow, the portfolio remains stable, withdrawals feel manageable, and long-term projections appear reassuring. But when early market losses occur, the experience can feel very different. A portfolio that was expected to grow may begin declining instead. Withdrawals start consuming a larger portion of the remaining balance. Even if the retiree continues spending the same amount, the perception of financial security begins to change. Trips may be postponed. Discretionary spending becomes more cautious. Large purchases may be delayed. Not necessarily because the plan has already failed, but because the margin of safety feels smaller. And this is where the structure of a retirement plan becomes extremely important. A resilient plan does not assume that markets will cooperate. Instead, it asks a more practical question. What happens if the first few years of retirement are difficult? If markets decline early, does the plan still work? Or does the entire outcome depend on favorable timing? Because once withdrawals begin, the structure of the portfolio becomes far more sensitive to market conditions. And the decisions made before retirement often determine whether the plan can absorb those shocks. Which brings us to the most practical part of this discussion. What lessons can be drawn from Robert's experience before someone enters retirement themselves? Robert's retirement story illustrates something that is often overlooked in financial planning. Retirement outcomes are not determined only by how much money someone saves. They are also shaped by when market returns occur once withdrawals begin. 2 retirees can begin with identical portfolios, follow the same withdrawal strategy, experience the same long-term market average, and still arrive at very different financial outcomes. That difference is often created during the first few years of retirement. So before someone enters retirement, several practical decision rules become important. Decision Rule 1. Before retiring, model more than one market environment. Do not rely on a single average return assumption. Instead, examine what happens if markets experience declines during the first 3 to 5 years of retirement. A retirement plan should remain viable even when early returns are unfavorable. Decision Rule 2. Evaluate Social Security timing before finalizing the withdrawal strategy. Delaying benefits can increase guaranteed income later in retirement. And stronger guaranteed income often reduces the pressure placed on investment portfolios. Decision Rule 3. Separate healthcare costs from general living expenses. Healthcare inflation frequently rises faster than overall prices. Modeling those costs independently helps avoid unexpected pressure on retirement withdrawals later in life. Decision Rule 4. Build flexibility into the withdrawal strategy. During difficult market periods, modest spending adjustments can slow portfolio decline and extend long-term sustainability. Even temporary reductions can make a meaningful difference when portfolios are recovering from market losses. Decision Rule 5. Understand that retirement stability depends more on sequence of returns than on average returns alone. Average numbers describe markets over long periods, but retirees experience markets year by year, while withdrawals are already underway. And that difference can quietly reshape the entire retirement outcome. So when Robert originally looked at his savings, the conclusion seemed straightforward. $750,000, 4% withdrawals, Social Security income. On paper, the plan appeared balanced. But over the next 20 years, one variable determined whether that plan succeeded or struggled. Not the amount of money saved, not the withdrawal rate, and not even the long-term market average. The outcome depended on something far less predictable: the order in which market returns occurred. And once withdrawals begin, that order can quietly change the entire trajectory of retirement. So perhaps the more useful retirement question is not simply, how much money do I need to retire? Instead, the question becomes, if markets decline during the first few years of retirement, what adjustments would you be willing to make?